The U.S. jobs report will get a lot of attention today, though it seems there's less and less room for the report to have a positive impact, even if the data comes in above forecast. The jobs report headline prints have been running at exceptionally healthy levels for quite some time, levels that on their own merit aren't in need of any additional confirmation to justify policy normalization. So any above forecast prints on NFPs or any drop in the unemployment rate shouldn't really do much at all. Moreover, there's been a clear shift in Fed focus these days, with the central bank clearly worried about downside risks associated with U.S. protectionism. This was reflected loud and clear in Thursday's Fed minutes. The one area of focus in the jobs report that has been significant in recent months has been the hourly earnings component. Hourly earnings have not been able to confirm the strength in the headline prints, a distressing fact calling into question the strength of the economic recovery. But even here, the impact seems like it will have less meaning, with the Fed already dismissing the need to overreact to any inflation overshoots that might come from higher earnings, and more importantly, with U.S. trade policy becoming a bigger consideration to the Fed's policy outlook. The key takeaway here is that from a price action standpoint, we see greater risk for letdown, which could lead to dollar weakness, particularly against the major currencies, and risk for more downside pressure in the stock market. As far as the data breakdown goes, here are the key metrics. As far as the NFPs, they're expected to come in at about 195,000, around the 12-month average, down from 223K previous. Average hourly earnings, the monthly is expected to hold steady at 0.3%, while the yearly is expected to tick up to 2.8% from 2.7% previous. And the unemployment rate expected to hold steady at 3.8%. Remember, the unemployment rate is exceptionally low right now, sitting at its lowest levels since 2000. There is the participation rate also, which is expected to hold steady at 62.7%, and this one is trying to work its way out from 4-decade lows. Looking at key levels right now, Euro 118.53 above, that's the June high, that's a critical level of resistance. 15.92, the current weekly low below. Cable 32.93, last week's high, is a key level of resistance above, and 30.50, the 2018 low, is the key level to watch. That's the low from last week. Dollar yen 111.40, the May high above, and 109.37, last week's low below. That's all for now.